world is on fire. There may be large objects in space hurling towards us the way things are going. Gold and silver are still suppressed, and we're all trying to become millionaires. Well, I'm here with Lior Gantz, who can tell us how to get there. Let's go.
One stacker on a journey to find silver. International Stacker.
Ladies and gentlemen, International Stacker back here again, and I'm back here with a channel favorite, Lior Gantz. He's famous around the world, but Lior, I'm going to turn over to you. And for anyone who doesn't know who you are, give us a quick recap on who you are and your expertise. And then I want to talk about the state of the world and what's going to happen next.
Hey, so great to be here again. In terms of my background, luckily, my father went bankrupt when I was 13. And I say luckily because it made me start to investigate and look into finance and economics, etc. And I started to work actually when I was 13. And because I saved up some cash, by the time I was 16, I had my parents waltz into the bank and sign a waiver that I can start trading equities as a teenager. And that was 22 years ago. So I've been an investor for 22 years. And around 2014, 2015, I saw that, I was 30, and I saw that most of my friends that were 30 did not know even 10% of the economic history and everything that has to do with the way the world really works. And I was like, why is it? And it's because of the different path we took to education. I was way more of a book reader and taking my information from different sources. And so I decided to launch Wealth Research Group, which is a free financial newsletter, as a way to kind of bridge the gap that people have in terms of their financial education. That was almost 7 years ago. And what the newsletter, it's a free newsletter, and what it does is it marries three things that I occupy my day with. One is seeking out financial and economic education. Second is talking to hedge fund managers and to real estate fund managers. So getting back the best of both of these equities. And third, looking into investments myself. And that's what that's what the free financial newsletter is all about.
Now, Europe is on fire. Oil and gas shortages to the UK and the EU. We just came out of a worldwide pandemic, and I was joking in the intro when I was talking about an asteroid, but I wouldn't be surprised. What's next? Things are so unstable. Is gold and silver finally going to come in? Is it finally the day for gold and silver? What's your prediction? What's going to happen next?
I'm not bullish on silver for the next 6 to 8 months here. I think that we are, if 2020 was the year of the bubble and this sort of a blow off top moment for stimulus and central bank manipulation of the credit supply and everything, and 2021 was the year that people realized that there's something really wrong and that there's a huge bubble, and 2022 is the year that we start to deal with the bubble. I think that what we've dealt with so far are excesses in the financial markets, but 2023 is the year that we deal with excesses in the real economy. So what I mean by the real economy is mostly jobs and real estate. And I think jobs are going to start to trend the other way. If for the past 13, 14 years, getting a job has been easy, and getting a job on Silicon Valley is paid disproportionately more than a similar job outside of Silicon Valley, and overseeing people was like a status symbol, then I think that we're going the other way. We're going in the way of efficiency being a status symbol. Can my little nimble unit made of me and just a couple of other very efficient employees that are ready to do the weekends and burn the midnight oil, are we able to create a profit for this company? We're moving from growth to profits. And as we do this restructuring, I think that all of these growth companies and all of the excessive growth in the system is going to have to unwind. That means a lot of jobs are going to be lost. That means that a lot of real estate is going to be put on hold, and a lot of plans are going to be put on hold in terms of R&D and development and whatnot. So the next 6 to 8 months, I think that's when we get into a classical recession. That's when even the president can't even deny that this is a recession anymore. And that's when it becomes political, because if you see people losing their jobs, they're high-paying jobs, and then it trickles to lower level and whatnot. That's when it gets to 6 or 7% unemployment, and it becomes political. And that's why I think towards June of next year, towards June of 2023, is when you start to see the Fed getting softer on interest rates. And that's when actually I think that silver has a chance to form a generational bottom as the dollar forms a generational top. We've been in a 12-year dollar bull market if you look at a DXY index compared to other fiat currencies. And I think that as we end this, and you know, I know it's Thanksgiving is coming up, so if you have time and over the weekend, check out wealthresearchgroup.com/fake. And I wrote that report because the dollar is a fake haven in 2022, because everyone's selling their 60-40 portfolio, their bonds and their stocks and their real estate, and all cashing up. There's such a demand for cash, it makes the dollar appear to be a safe haven, but it's a fake haven. And in 2023, you're going to start seeing that unravel. In my opinion, the DXY index is going from wherever it is right now, around 105 at the time of this recording. I think in the next few years, it's going to around 80. And then that corresponds with silver going to 40, 50, and perhaps even 60 an ounce in the next 3, 4, 5 years. So I'm extremely bullish on silver once we enter the other side of this recession, and we start to see in the second half of 2023 the Fed changing its tune to addressing a classic recession. So that's one thing. But I don't think that they will address it in a time where inflation is already like 2 or 3%. No, I think inflation is going to stay around the 5 or 6 or 7%, and they will need to capitulate on what they're doing. So that leaves us with a very high inflation world where the Fed has basically signaled that it's not going to raise rates anymore. And that means that silver has a really good chance of delivering one of its wild moves that it does every 10 to 15 years. So I think that's my scenario on silver. I'm very bullish after we get on the other side of the recession part of the next 6 to 8 months here. Gold is a really good recession hedge. So differently from silver, gold is actually something that an asset class that could be very favorable as we head into the early parts of 2023 as a recession hedge, and as a very inversely correlated asset class to the dollar. I think that as we enter the second part of the year and the dollar forms its top, as I said, I think gold is actually going to be in a good position. So very bullish on both towards the second half of 2023 and more bullish on gold and on silver for the first half. But certainly I think that if you're not in a rush, actually just holding cash will give you a lot of opportunities in general in the next 6 to 8 months here. I think people don't underestimate what's coming here. It's going to be this is like the eye of the storm right now. So that's my point. That's what I think. And in terms of like where I think it's going in the next few years, in my opinion, gold can hit anywhere between 2,500 and 3,000 in the next 4 or 5 years.
Yeah, and you said so much in that, and there's so much to unpack there. But first off, I like the metaphorical eye of the storm, because all my viewers know I was literally just helping out with Hurricane Ian down in Florida. And I can tell you what, when people are hurting from a disaster, or people are hurting from economic issues and losing their jobs, they get desperate. And all of a sudden, things that we're used to every day don't matter anymore. You see people maybe liquidate metals, maybe move to completely different states or even countries. Like, it's unpredictable what could happen. And when you're speaking about the downturn that you think is coming, it reminds me of like the saying, during the Great Depression, where like instead of eating, people would just pull in their belt a little tighter. And metaphorically speaking, I think a lot of these companies are gonna start cinching in that belt to the next hole. And like, you can't really look at Twitter. Elon Musk did cut the fat and all that, but like at the same time, if you look at Facebook, they cut like 12,000 jobs. You're starting to hear of a lot of places cutting jobs. And even the Federal Reserve, if you like dive deep into what they're talking about, like they're really gonna, like, the way they're headed is forcing people to lose their jobs in order to try to curb inflation. And I remember when I took macroeconomics back in college, and they were talking about like health, like US really wants around 5% unemployment to be healthy, right? So I think you're right. I think there's going to be a lot of jobs lost, and I think there's forces maybe in the government, in Federal Reserve, making that happen to quote unquote make the economy healthy again. Like, what do you think about that?
I think that what I'll give you another analogy, basically. So in between 2001, after the dot-com bubble, in 2008, you had basically you had a mechanic and a manufacturer selling cars to individuals and telling them that this car is a phenomenal car. You don't have to worry about this car. This car actually doesn't need anything. Just drive it. It doesn't need to any tuning, any oil changes, anything. Just keep driving it and everything's fine. And you drove it until one day you were told everything's fine. So and I don't know why, but you didn't doubt it, and the car completely fell apart. The mechanic in this analogy is the Fed that told you there is no bubble in real estate. The manufacturer is the government that kept allowing all these banks to securitize the mortgages, and the average person was driving this car and wasn't thinking, "Hey, I'm taking loans that are way above my the way I can live," and wasn't doubting it. And then you had investors, so you had everyone in this little game, and the car crashed, and a total loss. And so the mechanic and the manufacturer came together. And they said, "This is a huge disaster for you to ever trust us again. Here's a brand new car, and come to the shop often. Everything is free. It's on us. Just come to the shop. We'll take care of everything. Any problem you have, we'll fix it." That is basically zero interest rates at bailouts. This is us giving you everything back so you can become whole again. And so this guy is traumatized. He just had a big accident. And so he comes into the shop often, and he drives the cars very slow. And that was the years of the recovery. People were taking it slow. They were not taking a lot of risk. It was even called the most hated bull market in history because nobody participated in it from the public. It was mostly institutional, and even they weren't buying. You know who was buying? It was buybacks. Buybacks were the biggest buyers of stock during the past decade. So it was like the mechanic buying his own stuff. And so we reached a point where now you're feeling comfortable. The car's good, actually. You coming into tuning, and save for some minor problems, everything looks great. The car gets better with each year. And so now you're thinking, man, this car is invincible. But then a black swan event comes in 2020. And the mechanic and the manufacturer say, we've been here before, and we're not going to let him down this time. So instead of driving the same car, we'll give you a new car. We'll put some turbo in it. We'll put all the features and just take it and drive it. And so people are like, this is amazing. A disaster is actually a good thing, because every disaster, I'm just getting richer. And people were feeling great. They started to drive the car everywhere, and they didn't care about crushing it because they'll get a new car for free. And that's the analogy of the bailouts and stimulus checks of 2020. People felt invincible. You go to Rolex stores, they're empty. You're flipping used cars, all these excesses. You're selling JPEGs of monkeys for millions of dollars. And won't you know it, it's 2021. And now the mechanic and the manufacturer are like, you're crashing this car all around the city, and we cannot have this. Like, it's a problem. You cannot keep doing this. And so now the mechanic and the manufacturer realize that they gave this person a car that's actually like an exotic Ferrari that he needs to drive around the city. So he's hitting the curbs and hitting everywhere. And they tell him, hey, come to the shop. We actually need to take down a little bit of your horsepower. You're overheating this car. And so now you're in the reverse scenario. The car is actually too good to be driving around the city. It doesn't fit the city. That's where we are right now. We've reached a situation where people are just driving recklessly or have driven recklessly, and now they're starting to realize it. Now the CEO of Google says, I cannot believe I doubled my headcount in the last 2 years. What was I thinking? So now he's going to reverse that. Same with Amazon, same with Meta, same with Microsoft, and all these other big ones that basically, if you look at the salaries of their employees, the base salary is the same as other high-level software engineers around the country. And the difference is these guys were signing talent because they gave them stock compensation. So the base salary was basically 10 to 15% of your income. The most part where you were getting options and RSUs and stock every year. You were making way more than the average software engineer. And so now you're going to have to get a job at a place where they don't compensate you with stocks. They give you the base salary. So that's going to deflate these high-paying jobs, which were unsustainable. As you know, when every year the market cap grows by 100 billion, then dishing out 3 or 4 billion to employees, it's tolerable. You can tolerate that. When your value has been cut in half, now you're looking at paying these employees money that could go elsewhere. So this is the huge restructuring that we're going through. This is the Ferrari basically getting fitted to the city. And at the end of the day, you're going to have a Ferrari in the city. So this is a different environment than in 2008. This is not a total loss of a car and we need to restructure the whole thing. This is an overheated car that basically needs to get refitted so it can drive around the city. But at the end of the day, once you're done with this reset, there will be casualties and will be problems and there will be victims. But the growth profile is actually very good for the U.S. economy. The U.S. economy, demographically speaking, and from innovation perspective and everywhere else, it's still the big dog. It's still the best economy. But it's going through this whole restructuring because it was basically giving people a free pass for too long, and they took advantage of it, and they were living way beyond their means as a society. And now we're going to get these excesses to come back to reality and go back to a healthy economy.
Yeah, I love that analogy. Please don't take my Ferrari. No, but I love that analogy, and I this stuff can be so complicated. Investing and ETFs and bonds and cryptos and physical commodity. It can be so confusing for people. So I think anytime you can break it down in an analogy like that and market analysis, I think that's phenomenal. Kind of jumping back to something you previously said. So 2 quick questions. First off, if you're not bullish on silver and you think it's going to hit a generational low, would that be a good buying opportunity, at least for physical silver? And what do you think that generational low is going to be?
I don't think it's going to be a generational low. I think it's going to be a generational bottom. So in other words, it could be that the bottom is 18 or 17. It doesn't have to be that the bottom is a low. It just means that around June is going to create a bottom and not go back to that bottom, perhaps ever, but for many more years. It's going to create a range, a price where the economic activity is towards a very bullish few years for it. The dollar acts in a very inversely correlated way to silver. And so whether we see silver going to 18 or 17 or 16 or 15, wherever it goes, around the time that the Fed is going to pause interest rates and give a lot of clarity as to say, hey, we've had all these excesses in the stock market and in the jobs market. We've turned the corner. It looks like we're winning the battle against inflation. And before this becomes too hard of a landing, we're actually going to pause interest rates, hold them here, and wait. And they're probably going to wait for a full year. And during that time, it's going to be a great time to accumulate silver. And once they start to say inflation is no longer a problem, in our opinion, I think growth is going to start to come back. Risk is going to start to come back. And that is when silver is actually going to climb higher. So I don't know if it's going to be towards the end of 2023 or inside of 2024, but we are looking at a situation here where you have probably a 12-month span where whatever you do to build that silver portfolio, it can be physical, it can be the leverage ETFs, it could be the miners, it could be anything, it could be options, etc. Whatever you do to build that, I think the risk reward of this as we enter the recession, and now you're pricing silver for a recession and for the pivot after a recession, the risk reward becomes unbelievable. And you're going to see Wall Street, try to price that in advance as much as they can. And I think that is how you get that generational bottom. So, we don't know where it is. It could be 20. The point I'm making is that we are setting the circumstances and the conditions for a generational bottom, a level where once it reaches it, it probably doesn't reach that again for years, and we start to see a 100 to 200% move in silver from there. So if you're looking for physical, fine, but I'm telling you it's a generational move, so you might want to be more sophisticated than just the physical and look for other ways of capturing the appreciation, because if silver goes on a 100% move, there are a lot of assets that can move about 10 times that much and don't offer exotic risk. This is not a leverage place. These are just companies and businesses that their growth profile actually goes 10x when the price of the metal does double.
I like that. And quick question on miners.
And by the way, it doesn't have to be just this or just that. Okay, so you can do both.
Yeah, no, I get that. And I do like doing multiple things, that way, because I've always looked at physical as a hedge against inflation, whereas I look at miners like a true investment, where you can 10x or 15x or whatever that ends up being. But if this unfolds like and side note, whenever I am getting into like gold companies, I really love when they mine silver as well, right? Because I feel like more protected that way. And if silver does this, there's opportunity. But the question for you is, obviously we've got oil issues, we got energy issues, costs have gone up with that. We're going to have things tightening. Do you think miners are going to be safe, for the next year? Do you think they're going to be immune to it, or some smaller ones going to get burnt up in the furnace of what's going on? Like, what's your thoughts there?
So labor and energy are a big cost for these miners, but the bear market that preceded this era for the miners, the miners have been in the bear market for almost 12 years now. So they become very efficient, and they become well-managed companies as an asset class. And I think that they've seen $100 oil. They've seen wages go up. So the answer is, if we are entering in the next 6 to 8 months a real recession, if you remember 2016, that's exactly what happened. The Fed on the 15th of December, and I remember that because that's why I started Wealth Research Group. I was like, they're going to raise rates for the first time in 6 years. This was December 2015. I have to make sure that people understand what that means. And surely they raised by 25 basis points in December. And one of our first articles that was out was this was the bottom for gold. And gold bottomed actually on the 15th of December 2015, on the day of the meeting, at 1,053. And silver was, I think, 12 something. And they both bottomed and started to climb from there and never looked back. Actually, silver did in 2020. But early 2016, we started to profile these miners, and between January 2016 and August 2016, we saw around 12 companies go up by double, triple, quadruple, 600, even 1,200% for one of them. And it was during the time where the S&P 500 was actually falling by 12%. So I think that the miners, you have to just make sure that you are on top of them. Have a watch list of companies, and if they start to break out, then you need to be on it. This is a trade, not a buy and hold. This is not the sort of company where the growth profile is, my God, this could be an incredible company in 5, 6, 7, 10 years. This is a move, and you need to be on it and out of it. It's a trade. So I think that's how I feel about the miners. They're not buy and hold companies. These are very cyclical, boom bust industries, and it's very different than the traditional investing that I do, where I look for companies that I can marry for 5 to 10 years.
I really want the bottom to be 99 cents, Lior. I really wanted
For what?
Yeah, make it 99 cents so I can buy it all up and back up the truck for silver.
For silver.
I'm joking.
They ask me they ask me all the time where I think the bottom could be, and on a global basis, we mine silver between 13 and 15 an ounce. So to me, that's the worst case. Between 13 and 15. Now, in COVID, it went to on the COMEX around $12, and that's because they thought they're going to shut down the world for 3 years. So that's an indication for you of the worst type of pricing for silver, where there's not going to be any industry for 3 years. So I don't think it's going there. But could it go back below the 20 before June? Yeah. And am I right about June? We'll see. But I do think that we will see a real recession, classical real recession, where you see people packing their boxes and leaving their office, and the age of quitting because there's another job opening, that's over. So I think that's kind of where we're going. Like I said, I like gold a little bit more than silver because it tends to perform way better in a recession. If Wall Street starts to price in the days after recession early, then these miners are going to fly way earlier. So just because there's a recession doesn't mean Wall Street is going to treat it like a recession. In March 2009, the S&P 500 and the NASDAQ bottomed. If you look at how rotten the economy was in March of 2009, you would be like, how is this possible? How is the market on what is it rallying? What is the catalyst for this? And it's just because Wall Street has seen enough things to where they said, this is as bad as things could be. So now I'm going to start buying. And it could be that it happens way earlier than you think. They just start to price in the day after the cut because they know or they speculate that there will be a cut or a pause, whatever they feel like is a catalyst. So that's why I say have that watch list ready, because if you see the breakout, you don't want to be theorizing that, hey, this is not it. How can this be true? No, if Wall Street buying, that's what drives these stocks higher, not the retail crowd. If Vanguard and BlackRock and the GDXJ, if these sort of companies, Fidelity, start to buy your miners, they will start to move.
Yeah, I like that. And I like it. Do as we say, not as we do, saying kind of comes to my mind there. But I think it's already happening, Lior. Like, we're seeing layoffs, we're seeing more stuff in the news. And what you see in the news is really the tip of the iceberg. Who knows what's really, going on behind the scenes. And I think you're right. I think that will start to unfold over the next few months. I have a very quick question before we kind of jump to another maybe longer term question. But for when you're in a stock or, a company and you're investing, how much of a loss will you take before you say, nope, I'm out? Like, what's the percentage that you usually are selling it and cutting your losses and moving on?
It depends. It's different from company to company. What I would say is, um, I I look at uh, the financials. That's what I care about. So if I look at the financials and if I listen to the CEO and the CEO gives me a good vibe, I need to really understand that guy. I need to hear what he's saying. I need to really understand what I'm hearing. And if I don't like anything, then it's not for me. So I don't have a very diversified portfolio. My portfolio is around 15 companies that I think are the best companies in the world. And to me, those companies, that's all I try to do is take that basket and I add around one company there a year. Um, and what I try and do is just be an expert on those companies to as much as I can. And I would rather know more about them than research new companies. So that's where my mind is at. Now, if a company in that portfolio drops because of a situational problem that it has in and of itself, that's something where I can say, hey, the company's changed. I don't want to be an investor anymore. It's lost its competitive advantage. It's not a great business anymore. Now, if a company is falling 50%, which Amazon is falling 50%, and it's because of a short-term problem or because the Fed is raising interest rates and everything is compressing down, that's a different situation. Then I can be more lenient with the amount of paper loss that I'm willing to sustain, because if I think the growth profile hasn't changed and in 5 to 10 years time the company will be triple where it is today in terms of its market cap, then there is no reason to sell. Why would I sell a business that's just going through a short-term crisis, and it actually will get more efficient and continue to drive forward? So that's basically the short answer. It depends on the situation. I'll give you an example. Two of the 15 companies, two of them are actually at an all-time high right now. So it doesn't. Not everything needs to fall with interest rates. Another company in there is actually down 50%. And so what I do is, obviously, the companies that are on all-time highs, I don't want to accumulate more at this point, but a company that I see reports, their quarterlies, and they're just crushing it, but people want out, or institutions want out because of interest rates, because of whatever. Those are shares that I'm happy to buy from them. So it just depends on the situation, and the more you know the businesses that you're a part owner of, the better for you, because you'll be able to decipher between short-term problems, real problems, and whatnot, and you'll be able to actually see where Wall Street starts buying them again. What are the valuations that Wall Street starts to buy this and sees the value in that company, in that particular company? I've gotten really good at saying, okay, at this price, there's a lot of buying from institutions. So if it reaches that price, I want to take another bite at this stock. And that's how you get to a situation where you get a portfolio of like 15 companies, and that comprises basically your entire stock portfolio. Maybe you add just a few other smaller type speculative investments, but that's it.
Now, Lior, if I just want to be lazy and just become a millionaire off your success and copy exactly what you do, right? Is there a place where people can go and see your 15 companies you're focused on and the trades and stuff you're doing? Do you have anything like that?
Actually, yeah. We will be publishing. We often publish the 15 companies, but what we're going to do now in December and going into January is I'm actually going to divide some time to give a very a lengthy, more of an analytical breakdown of each of them, And so we're going to publish that in the newsletter during December. And in January, we're actually going to pack everything up into one PDF. So you can actually just have that PDF on file with you at all times and have that information. And if I add to that list, then we notify on that as well. We actually added one company this year to that portfolio. So it's a very special type of company to be in there. And my strategy is just to know everything I can about these companies and to be on top of them, because these companies have proven to outperform the markets. And if you can learn more about them, it's easier for you to buy them at better timing, I would say, and actually even accelerate your return. These are companies that I don't trade out of. I just continue to accumulate when it's appropriate.
Now, is it true that the International Stacker YouTube channel is one of those 15 companies? Is that true? All right, serious question.
Yeah, sure. By the way, just so there's no mystery, the two companies, they're some of the most boring companies you would know. So one of them is called Rollins. It's the #1 exterminator company in America. The ticker is ROL. It's actually owned 55% of the company is owned by the Rollins family. It's a very expensive company today. So this is not the price that I'd like to purchase it at, but just giving you an example. And the second company is called Cintas, and all they do is they provide companies with all of the attire, uniforms, the extinguishers, everything you need for the office. They provide very, very boring companies. But if you go back and look at what these companies have done for the last 30 years, I mean, they've outperformed the markets by so much. It's not even a contest. So you look for these special dominator companies that are niches and are just well run, and just grow and grow and grow over the years.
I mean, I guess there's always going to be bugs, and people are always going to need uniforms. And unless everything gets automated, and then maybe it's robots. But maybe they make clothes for robots. Like, what's going on there?
I've spent hundreds of hours understanding their business model. It's way more complex than that. But I can tell you that, like, think of the average exterminator. It's probably not why people chose to watch this video, but just to give you like 30 seconds, most exterminators are mom and pops. This is like a corporate version of exterminators. So that's why they're so much more efficient. This is usually like a very fragmented industry, small-time mom and pop exterminators. This is a corporate entity with hundreds of these little brands under it, and they all run very efficiently under this one unified management. And that's basically what the competitive advantage of this company has, that I don't think that that they will be disrupted anytime soon.
Okay, that makes sense. Now, quick question for you. Do you think there's a unique opportunity here? Like, I've traveled around the world a bunch of times. Obviously, International Stackers, my channel. And I remember going to the UK and paying a ton of money for pounds, and going to the EU and paying a ton of US dollars. I should say fiat currency for euros. But now that they've dropped so much compared to the dollar, do you think it's an opportunity to buy in those, hold them, and then reconvert them? Or you think you'll just lose out on fees? Or do you think the monetary systems are going to reset anyway and it's going to be irrelevant?
I would say this. When about 12 years ago, I really got interested in foreign exchange and trading foreign exchange. And I went and did my due diligence. I literally went to a brokerage firm, to their offices. And I said, can I see the trading room and whatnot? And then I sat down with one of the traders and I asked him, like, could you tell me how many of your customers are green? How many of your accounts are green? The customers' accounts, how many know how to trade foreign currency? And he said 93% lose money in foreign currency. So on one hand, you have this trading market, the FX, foreign exchanges, and you can lose 93% of the time, or 93% of people lose money in that. And so it's a huge wealth transfer between the 93 and the 7. And on the other hand, you have a machine that's designed to make you wealthier. It's called the stock market. And it literally is built to make you wealthier and to become your second engine along with your career. It's extremely hard to lose money in the stock market just by buying America's 500 best companies and sticking with it, or its best 100 tech companies and staying with them. And I would say I would always defer to the stock market. Always, always, always. It's not something I would even think about, playing a game where the odds are 7%, where I have right in front of me a way to make 7.5% year over year just by buying one index fund and holding it for 30 years. So to me, it's not even worth thinking about fiat currencies and which ones are a bargain or whatnot, when the mother of all bargains is just to buy a piece of America and own it for the rest of my life.
Well, there goes my dreams of suitcases full of pounds and Swiss francs. So here's a question for you. You know, there's a lot of now switching to something more serious. You know, there's a lot of strife coming, I think, both geopolitical, market. You know, we've got Russia, who knows if that's going to spill over. There could be many other black swan events, like maybe electrical grids getting hacked or EMPs from the solar flare. Like anything can happen. But like, what's the number one warning you would issue to people watching this video right now for maybe the next 6 months, and how can they prepare for that?
Okay. Aside from a recession in America, which I think should be enough to worry most people, I think if people haven't heard of Malacca in the South China Sea, I think that they should study that trading corridor. If you go to wealthresearchgroup.com/Taiwan, it's a download report that's actually 20% about Taiwan, but 80% is about the Straits of Malacca. I think that could be ground zero for physical or military altercations between China and the United States. I think that is key area to know geopolitically. And anytime that pops up in any news feed, you should definitely see what are the updates on it. To me, that is something of a concern. So that whole area of the South China Sea. But for sure, the biggest threat that we have is that this recession becomes a severe one, and with a severe recession will come black swan events.
And I guess, how can people prepare themselves? Like what would you like? If everyone watching was your daughter or your son, what advice would you give them?
I would say you should really focus right now on becoming an indispensable part of your organization. And if you are the owner of the organization or the business, you should become indispensable to your clients. This is the time to think of your business almost like a startup. Hours don't matter, weekends don't matter, nothing matters. How can I become indispensable and go the extra mile? How can I work harder than I've ever worked in my life on satisfying whoever I need to deliver value to and over deliver to? And that's priority number one, so that not only do you not lose your place of employment, but you actually shine a light on yourself and actually even get to higher levels, or competitors may see what you're doing and recruit you. So I think that's number one. Two, with regards to how to manage your money, I think that right now is the time, counterintuitively to what people think, because we have high inflation. I do think it's the time to continue to stay very cashed up. You may lose 5 or 6 or 7% to CPI, whatever, but it's not like losing 20 or 30% in the stock market or in real estate or wherever, or in bonds. I think that actually the least risky thing to do right now is to be either in cash or in gold. So until we see clarity from the Fed, until we see, hey, we're done, no more interest rate hikes, or we're pausing, and we probably are pausing for 1 year, until we see something where we know it's not going to 7% or 8%. I mean, you need to wait. You need to be very patient. This is the time for patience, because everyone else that's fully invested is going to run into trouble. So those would be my two things.
What's your final words to everybody watching? What's your final thoughts here?
We are moving towards the new economy. And in the new economy, we live in a deglobalized world with plenty of amazing opportunities in all sorts of areas that weren't a problem before. So I'll give you an example. I think that every company that imports or exports is going to hire or create a role for a chief supply chain officer, for example. Those will be people that actually all they do is worry about supply chains and warehousing and solutions of that sort. The zero COVID policies in China, I think that they will stay with us for a few more years. And therefore, I think that a lot of manufacturing is going to go back to America, not like cotton and shoes and stuff like that, but high-end, sophisticated stuff. And I think that if you look at areas that are an hour and a half to 2 hours from the major cities, you will start seeing manufacturing hubs where a lot of automation and robotics is going to be employed, and they're going to supply these cities. So instead of getting stuff from halfway across the world, you're going to get your stuff from 2-3 hours away from your city. And that requires designers, engineers, a lot of high-paying jobs. That's opportunity. People are not going to go back to 5 days in the office. Most people are going to work hybrid from at least for many more years here. And they're going to build their lifestyle around that. That means new types of houses. That means new cybersecurity at the house because you're taking all your work to your to your workplace or your workplace to your home. And it's a whole slew of things that are going to change. So huge opportunities for those that are ready and are willing to look at the world from these new lenses and are ready to birth the new innovation in all these industries that are ripe for this disruption.
All right. Well, I'm stacking my paper because I feel like there's good opportunities coming there. I'm going to go. I think next thing I'm supposed to do is crash the Ferrari. So I'm going to go work on that. But Lior, thank you so much. I always love having these conversations with you. Where can people find out more about you and what you do?
wealthresearchgroup.com. Subscribe to the free newsletter. That it will always be the best way to stay up to date.
All righty. Well, thank you again. It's always a pleasure to talk with you. And it's the end of the video, and I'm going to test you. It's been a while since we've done this. Do you remember? Okay. Do you remember what I say at the end of every video?
I don't.
I feel like you got it. It starts with the C. I feel like you got it in your catch
you in the next one.
Catch you on the next one. Woo!
Okay.
One stacker.